You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That funky music means it's time once again for TWIFO, This Week in Futures Options. The program where, as the name pretty much sums it up, we break down the week that was, and in some cases still is, in the world of futures options. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. If you guys are just listening to this show, just subscribe to this show, first off, we love you. Secondly, you may want to consider upgrading to the full network. That gives you all of our shows. You get our news show, get our volatility show, you get our daily option block show, all the fun stuff that we do. These places find all that, of course, wherever you're listening to this, iTunes, TuneIn, Stitcher, our website. You can check it all out there, of course. And however you're listening, make sure you hit us up. Questions, comments, insights, pearls of wisdom. We do love to hear from you guys. And, of course, nice little fun bonus for all of you who can join us live. We come live and stream it live every Friday, 1:30 p.m. Central, 2:30 p.m. Eastern, via Mixlr, MIXLR. So if you follow us on social media, you'll see the link. Grab it once, set it, and forget it. It's the same link for all of our shows. Of course, you can always follow us in Mixlr. I know a lot of you like to do that too, so you get notified throughout the week whenever we go live with all of our shows. And again, however you listen live after the fact, make sure you hit us up. Questions, comments. We do, maybe except for Nick, we do like to hear from you guys. And joining me on the old program today, of course, my cohort, my partner in futures options crime, Mr. Nick Howard, the founder of Bantix Technologies, the creator of a little platform we like to use quite a bit around here called Quick Strike. Nick, welcome back to TWIFO, sir.
Hey, happy Friday, and hopefully we get some good questions and we can talk about some stuff that's getting released this weekend, so looking forward to it.
A lot of fun stuff popping off this week, a lot of fun stuff to talk about. We are also joined, it's always fun when we get a hot seat guest in the studio. It's always even more fun when one of our CME hot seat guests is actually from CME. And this time we are happy to be joined by Derek Sammann. He is the global head of commodities and options products over there at CME Group. Derek, welcome to the TWIFO program.
Thank you, Mark. Appreciate being here.
All right, it's going to be a fun show, so let's get to it. I thought we'd start off, even before we got into breaking down all of the nitty-gritty of all the products that were lighting it up this week. Kind of a bit of a historic week this week, kind of a bit of a maybe auspicious week this week. It depends on your viewpoint. Of course, yesterday was the 30th anniversary of the big market meltdown known as Black Monday, a moment where we saw, of course, a lot of capital in the marketplace erased. So the viewpoint has always been predominantly negative, and that's certainly understandable. But people who look at it maybe from the options lens have a little bit different perspective, because that event was certainly formative when it comes to creating the modern options market, the modern options industry that we know today. Concepts, things like skew and many other things were born out of the tumult of that day. Prior to that, we had pretty much a smile. Everyone thought options traded that way. Then we learned, much to our dismay, that wasn't exactly the case. So a lot has happened. A lot of the firms we see in the modern options marketplace are the survivors that have come out of that wreckage and emerged the stronger for it. So a lot of the formation, the infrastructure of the modern options market would not be the same without that event. So there is maybe a little bit of a rainbow in that dark cloud. Derek, I know you were down on the floor, not on the event perhaps, but certainly not that long thereafter. And I know when I came into the markets about a decade later, the shadow was still very long then. So for you, it must have been even longer. I'm curious, what are your thoughts on this kind of inauspicious anniversary? But also maybe from an options perspective, what are your thoughts on maybe the impact of that tumultuous event on these products we talk about every day?
Yeah, if it's interesting. I came into the business in 1990 and learned from the guys that came out on the other side of 1987, on the right side of owning wings, buy the low deltas. Never, ever try to make a career by selling the teenies. That was a lesson hard learned through many that went through that experience. I had the benefit of a couple years of hindsight of the folks that employed me, and I was started on the floor as a floor trader. I learned long and hard those lessons of buying the low deltas, managing the kind of that volatility component that really was, I think, massively underestimated and not really calculated before 1987.
Yeah, it's funny. I guess it called a bit of a survivor's bias, because the people who survived that event were the ones who weren't out there blowing away the teenies, as you like to put it, the really cheap puts or sometimes cheap calls, to try to harvest all those little, the old analogy, picking up nickels in front of a steamroller. They weren't the ones who did that, because the ones who did that certainly weren't around in a year or two after that. So yeah, a lot of interesting takes. Nick, this is probably near and dear to your heart as well, because every week we talk here about quick skew. That's kind of fundamental to what you guys do over there at Quick Strike. A lot of our listeners love talking about all things quick skew, and yet, it'd be pretty boring if there wasn't a 1987 crash, because we'd be saying, everything's a smile 24/7. So, what are your thoughts as we look back on 30 years now on the old Black Monday?
Well, in 87, I was out of college. I just out of college for a summer. I wasn't in the markets yet, but I have one memory of that day, and I also have another comment on top of that. My fondest memory of that day was watching one of the principals of the company run around the office because he was getting hammered in the market. So that was sort of my first introduction to seeing people really panic when the market was having some trouble. And then secondly, the skew, as much as was learned that day, I had a harder personal lesson about skew later on in the interest rate market, because, back when I was on the floor there, a lot of the stuff was priced in a black model or some sort of model, American model based on black, obviously. But even then, in the short-term interest rates, that model wasn't necessarily appropriate to give you correct levels of skew when you're looking at the downside puts in comparison to the money or the out of the money calls. So there were lessons to learn in skew even after I had my personal Black Mondays in the interest rate market. So that's why I like skew and volatility so much. Although I never sold wings, I did learn my lesson on buying wings, in particular puts. So Yeah. So are you trying to upset me today on a Friday where I'm already
It's a fun remembrance. We're looking back at the positives,
That's
the positive
good.
spin-offs. We can go. We're not going to go down a dark place for Black Monday. It's we're looking at the positive ramifications here on the show. You're right. It's interesting. I think everyone kind of learned collectively. And if you're going to be net short units, particularly to the wings, that could be a thing that could come back to haunt you, sometimes quite literally, as we saw. And if you didn't learn that lesson then, you had multiple shocks in the 90s, of course, the big meltdown in 2001, 2008 again. So if you didn't learn that lesson then, you've had a few chances since then to perhaps awaken to that lesson. Interesting stuff. Listeners, I'd be curious to hear your thoughts on all things. Everyone's been opining all their different takes on Black Monday. But I think from an options perspective, it's a little bit of a different beast over here. Let's move on to some of the things that were lighting it up this week. Crude and energy, always top of our mind here on the old TWIFO program, probably because that's top of your guys' minds a lot as well. You guys are always hitting us up with questions and comments about all things energy. So maybe, Derek, we'll start there. I know a lot of your time as well these days is spent pretty much in the energy complex, looking at all the things that are trading over there and some of the interesting developments. So maybe before we dive into the nitty-gritty of all things WTI and who's slinging what, give us a bit of an overview of what you're seeing in WTI as well as some of the other interesting hot spots out there in the energy complex these days.
Yeah, energy has been a terrific source of growth for us at the enterprise level all year, Mark. Certainly with the gyrations in the underlying crude market, WTI, and the record levels of both production in the U.S., but more importantly, exports from the U.S., really positioning WTI as a waterborne global benchmark. We are seeing growth come out of every corner of our markets right now. In fact, I just pulled the stats on Q3, and our Q3 energy business from outside the U.S. is up 73%. Massive participation from Europe and Asia. And that's exciting. That's also a function of our ability over the last number of years to continue to electronify liquidity in our market. So you've got actionable liquidity in every time zone. So excited about the growth there. Options continue to track accordingly. We're seeing good growth both in WTI. Natural gas options, we spend more time talking about WTI, but I'll talk about natural gas for a minute because natural gas is a market that 2 years ago was 100% brokered. There was no electronic screen liquidity really anywhere. Seeing the success that we've seen in WTI over the last couple of years, we took a very specific path to electronify nat gas options. This is a 200,000 contract a day market, so good sized and really reflects some really interesting different fundamentals than crude. We've now both grown that business, but more importantly, we've taken that business from basically 0% on Globex to 50%. So we're trading close to 65,000 options a day just electronically, which had about 100,000 overall. And this is a market that we've really been able to electronify and bring global participation into. So when we electronify a market, that means we can have participation in Europe, in Asia, in Auckland, in Zug, Switzerland, and allow the global participants to directly interact with our screen liquidity. So in a market that is sometimes feeling like it's going sideways or volatility drifting lower, we have continued to show growth by adding participants, adding discrete points on the curve, and creating electronic access to our market. So it's a little different take on the energy world. We normally spend our time talking about WTI, continued strong growth story there, but nat gas is something that I think you're going to see place more highly on the radar screen to the global energy market over the next couple of years as you start to see natural gas exports out of the U.S. as a result of fracking.
Yeah, you're right. The fracking story has really kind of changed the narrative on it. Because you're right, for a long time, it wasn't really that accessible to a lot of the listeners out there. That's probably why we haven't gotten, particularly on the retail side, a lot of feedback on it. It was heavily brokered. It wasn't that electronically accessible. And there was kind of a dearth of strikes, too. It was like 2.5, 270. It was kind of a hard thing for the newcomer to come in and look at this thing. Well, it's trading around 3 handles. And what do I do with this? So I think now that you're seeing a little bit of movement, a little bit of action out there. And you're right, the volume's starting to creep up. We've been watching it a little bit here on the old quick strikes. That's something I think we're going to have to start working into our now. I don't know. What do you think about that, Mr. Nick? You think we should start adding in a nat gas to the crude oil breakdown when we're talking energy these days?
Yeah, I think it's probably a good idea. I mean, we didn't know too much about crude oil when we started, and I think that probably dominates most of our conversation. And I know I have been talking to Jeff White over at the CME too, and he lets me know about when there's the increases in the open interest in the volume. So we'll pay a little bit more attention, and maybe we can squeeze that in there as well. I mean, just looking at the report now. Again, if you're listening live, you can follow along at cmegroup.com/TWIO or /TWIFO, and the links are live, so you can jump in and see the historical volatility skew, the prices, all that kind of stuff, the detailed volume for the week. But the thing that strikes me just looking at it and just eyeballing it like we try to do when we are on the show and we're looking at a product that we aren't necessarily watching during the week or aren't extremely familiar with talking about on a weekly basis. But it's what's interesting is just the amount of, it's kind of a pretty steady amount of open interest across the term structure. And that for me is always a good sign that there's a good interest or something to pay attention. I mean, there's over 2.4 million in open interest, up 5% this week so far. But you see November, December, January, February, and March all up or over 300,000 in open interest, and all up for the week. In particular, Jan quite a bit at 10% increase in open interest. So yeah, we should definitely take a look at it. It's always good for us to be forced, our hand to be forced to start paying attention to stuff, because you really don't learn about it until you have to be pressed with questions and expectation that that's going to get covered. So it's got some interesting skew to it as well. And I hesitate to say anything about it because I believe it's seasonal in nature, just based on the months that I'm seeing. But we'll take a closer look at that and then have some comments as we go forward.
Yeah, it's an interesting addendum, and you're right, Nick. The natural gas season, as it's referred to, really starts in September and ends in about April or May, because it's effectively a heating source. Now, increasingly, it's also a fuel source and a clean fuel source. So as we're also seeing the world kind of pivot away from sources like coal for fire generation and electricity generation, we're seeing nat gas picked up as well. So it's becoming a little bit less seasonal, but that's a structural shift that's taken a couple of years to play out. So we're excited. It's good growth on our venue, and electronification is always one of our favorite stories. But I think you were referencing some of the interesting strikes in the 50 puts, particularly in December, having some really interesting price action this week, and certainly with the talk about Saudi Aramco is maybe pulling their IPO, and we're seeing now record levels of export of crude out of the U.S. Certainly, you've seen a reversal of some of the price action, and not surprisingly, seen that reflected in the price action and the kind of the hot spots on our grid relative to the tools, Nick, that I think you guys can highlight really, really well for folks that are looking to see what's going on and what the quick feel is in the markets right now, in WTI specifically.
I like it, Nick. I think we'll have to put nat gas on our radar going forward. I think there's a lot of months. You're right, a lot of action across the months, which is something we actually like, not just a huge concentration. So a lot there for us to sink our teeth into, as we sink our teeth every week also into all things WTI. Another interesting week. The market actually settling up unched on the week, which is kind of interesting after a little bit of, will they, won't they, kind of settling up, kind of the same place we were last week, which as always means vol is going to come in yet again, and it did that again this week. Not quite as much of a drubbing as we've seen, just because this vol is already getting fairly low, certainly on a year or two scale. If you go back farther, obviously vol can come in quite a bit more, but still, at least this period or so, we've seen vol coming in. So all you keep writing in saying, when is there going to be a chance to buy premium? When is there a chance for his vol turnaround? We have yet to see that sustained spike out there in WTI volatility that would certainly bring a smiley face to all of you premium buyers out there. And as Derek alluded to, was an active week, actually up nearly 6% in open interest, about 153,000 contracts this week, which is certainly an active week out there in WTI. It probably belies the nature of the futures settling unched, a lot of action in between there to drive a lot of that volume. And as Derek alluded to, the 50 puts out there in DEES were leading the charge this week with a total of nearly 43,000 contracts on the week, about 15,000 on Tuesday. That was the big volume leader. 11,000 on Wednesday and nearly 10,000 on Monday. Not so much today, only about a couple of thousand going up on the tape. And the interesting about this, in the last few weeks, we've been talking about WTI and pretty much how all the strikes were net unched from an OI perspective, which was somewhat odd. We didn't see a lot of net positioning in one direction or the other. People were just kind of churning and burning. This week, we're seeing a lot of opening on the 50 put strike, which is kind of, as you might expect. The 50 strike is certainly where a lot of the action, where a lot of the psychological levels and support and resistance are. So we see a lot of action out there again this week. It falls off a bit after you get away from those 50 puts out to the 52 puts. So still puts leading the charge here with about 23,000. So now about 20,000 less than those 50 puts. Again, the lion's share, nearly half, coming on Tuesday, 10,500 or so. The rest kind of scattered throughout the week. Again, about 10,000 and change net opening, about half. So an interesting trend this week as opposed to last week. People coming out and actually reestablishing, which is perhaps interesting and a little bit good to see out there. People are starting to take some more positions. The calls, all you call lovers, all you bulls out in Crude, you weren't left behind. The 55, the double calls, also pretty active this week to the tune of about 20,000. The lion's share actually kind of evenly split between Monday and Tuesday, about 6,000 and change on both days. Today, kind of a paltry 1,100 or so, about 4,000 and change net opening there on the week. And let's scroll a little bit farther down to see, as we are wont to do, any action out there in some of these other months. We see June next year, double calls, also pretty active out there, about 13,000 and change as well. As you go farther out the term structure, kind of a quiet week if you want some outlandish ones. We did see the par calls, the 100 calls, pretty active out in Dees 2018, 1,500 of those going up this week. So for all you bulls, that came up on Monday and Tuesday, 500 on Monday, 1,000 on Tuesday. Actually not opening, so that's kind of interesting. Perhaps a little bit of closing paper there on the par call. Someone perhaps deciding discretion is the better part of valor after all. Mr. Nick, a lot to parse this week out there in WTI. Even though we net settled on the future, still a lot happening out there, which is kind of interesting. What caught your eye out there, and what, if anything, was happening in quick skew land this week?
Well, I think what caught my eye initially, probably unrelated to the tools, are just the headlines that you're seeing about crude. People are making a big deal when we cross like a 51 price threshold or ranges that used to be of no interest at all become interesting, especially when you go back and look over the amount of time. If we go back to the article we discussed a while back, and I don't know if it was Bloomberg or Goldman, where they said we think that crude's going to be between 40 and 60 with some surprises, right? So if you go back and look over the last several years, I think it netted out to
like, what, 35 to 75. They give themselves enough cushion.
Yeah,
that was a very daring prediction on their part.
Yeah, it was crazy. So if you go back and look, I mean, we really are in that range, but and we still have not really. We hit like 52 3/4 earlier in the week, or last week, or late last week. I think it was early in the week if I look at it, and we just can't seem to. We can't seem to breach some of these sort of open interest max tops that we see in the on the upside calls or on the bottoms on the put. So from my standpoint, given that our range is so tight. And the vol is creeping in, but again, our prices are lower, our vol's in, so it's all relative. We still have great open interest increases, week over week, and again, what caught my eye here is just moving, the WTI is a little bit different. It trades the Dees in the March and the June. That's where you and the next Dees. So that's where you see really where your increases are. But we saw some significant increases in what we traditionally call the serial months, right? The non-quarterly months. So that was the first thing that sort of caught my eye. And just kind of emphasizing the fact that we're in a pretty sturdy, steady long-term range here, but we still have trade. So. For us, it's always important to see the increased open interest and the trade around that. And we see the openings, like you said, there's a lot of openings in a bunch of different strikes. And again, always a positive from my end when you have a pretty tight range and you don't have a lot of news pushing you one way or another, but you still see people getting into the market. And then as far as the skew goes, we're not seeing much change from what we saw last week. We still see the puts bid and we see the calls offered. And I was looking back over we have like a 55-day option in the Jan, a 30-day option in the deck, and I was looking back at the quick skew on the constant maturity, and on the 60-day, we're not quite at our highs from that 60-day constant maturity separation of richness in the put and cheapness in the call, but we did push out this week just a little bit, so. We have some room there for the skew to increase bid on the downside and offered on the upside. So those are the things we watch out for. Other than that, we didn't see anything out in the longer term change in skew. It's pretty flattened to what it was last week. And then no, outside of your mention of the par calls, not a tremendous amount of outside the range calls trading, some, but not a great deal. So that's kind of what we're seeing, it's kind of grinding along on the volatility, curve shape, not changing too much. But again, for me, the positive is the increased open interest on a tight range. Just wait until we get through 55 or 45 again. It's going to be really interesting to watch what happens.
Yeah, nothing, certainly not as outlandish as that crazy gold trade we saw a couple of weeks ago, which people are still writing into us about. So they still have their thoughts on this. Derek, before we move off of the energy complex here, anything else catching your eye out there?
Yeah, I think Nick makes a really good point. I mean, this is actually the case in every asset class. We're almost at historical lows in every asset class, energy, metals, FX, equities, yet we're finding new ways to give risk management tools to our customers delivered electronically. So even in we are seeing sort of tight ranges, there's volatility within very tightly parameterized ranges, as Nick points out. And I think what we track and follow very closely, as Nick pointed out, is look at the open interest. That will tell you if you see volume growth associated with open interest growth and large open interest holder increases, that's a risk-on environment. And a lot of people think that volatility lower means risk-off. The reality is because we've invented and developed so many shorter maturity points on the curve, whether it's the weekly crude options or the weekly Wednesdays in treasuries or the weekly Mondays in equities, lower volatility means lower premiums, which means you have a really cost-effective ways to play for tighter moves inside a parameterized range. So, those are things we focus on. Despite we can't control for volatility, we can't control for geopolitics. I can't control for what OPEC is going to say or not going to say. What I can control for is putting the right products into the hands of our customers, delivering that electronically so that no matter what the shape of the yield curve, no matter what volatility looks like, we give customers the ability to trade, manage risk, take positions, and otherwise, understand where they are on the curve and how best to manage their exposures. And we're seeing that in growth in volumes despite the lower volatility.
Yeah, it's kind of been the story of the year across a lot of products is, volatility is anemic in many products, yet we're still seeing surprising resurgences in terms of volume in a lot of things, which is, I think, probably contrary to what a lot of people would have assumed coming into this year. Speaking of contrary, as we get into some of our other products, the metals and others, as we are wont to do, we always talk a lot of the shiny stuff, Derek, but, seems like there may be some interesting stuff going on in the less sexy metals out there, the ones we don't get a chance to talk about as much here on the show, the less shiny, more productive type of metals, including, I think you guys, as if my graphics here are to be believed, have a little bit of a new record here in the old copper, Derek. Is that correct?
We do indeed, and actually that's as much a reflection on the focus we put on the industrial metal side of our COMEX business. For a long time, COMEX was synonymous with market leadership in precious metals. Absolutely true then, and even more true now as we continue to grow our market share. About 2.5 years ago, we recognized that there was a pretty significantly unmet need on the industrial metal side of the business as well, primarily copper, but aluminum, lead, zinc, other, the industrial side, to your point, a little less sexy. Nobody's walking around with a copper ring on their finger, but I wear gold personally. Others might wear copper.
And all the healing benefits you see touted these days. People are starting to wear copper, so maybe that's part of the comeback here, part of the open interest.
But what's cool about what's going on is we're actually, over the last couple of years, we've taken our market share in the global copper business, not just options, but global copper from about 13% 3 years ago to over 26% this year. Copper this year to date is up 28%. Every time President Trump opens his mouth and talks about infrastructure bill, our copper flies. Anytime anyone starts talking about resurgence growth in China, our copper product flies. So what we've now pivoted to is now focusing on, as we've got that great growth core business in the futures, as always, you got to see futures business growth before you can focus over on the option side. Just 3 months ago, we put a very specific sales campaign out globally to push the benefits of trading electronic copper options on CME. And we've taken that business from less than 100 contracts a day to, I think we had a record day the other day, 3,000 contracts, 50% of which is traded electronically. And that's very unusual to see that kind of growth electronically. Oftentimes it'll start with OTC participants blocking business in an institutional size. This is a Globex market from the start. And to the point you just made, we just hit another, we seemingly hit these every day, copper options open interest record, 14,000 contracts. It might not seem like much, but when you look at the broad use of options on exchange in copper, we're growing faster than anybody else right now. So we're excited. It's a nice complement to the story that is precious metals, because precious metals, Frank and Mark, it's more like a financials product. It's kind of like FX. Industrial metals has a very different feel and a very different user base as well. So if you're playing for global resurgence, infrastructure, global growth, kind of an economic restabilization, copper is a fabulous way to take a position on economic stability and economic growth. We've seen that again and again. So we're investing when the market volatility is down. So to the point Mick made, when volatility respawns, we're starting from a much higher starting point, volumes, open interest, and participation.
Yeah, that's one of the reasons we do this show is we, to get into the weeds and some of the other products you don't get a chance to talk about. So maybe our surprise product of the week there, copper, setting some new records. Nick, I know you've been digging here into the old quick strike to see what secrets it holds on copper. Anything interesting coming to note, sir?
Yeah, we talk a lot about the fundamentals and then also the technicals, right? So Derek mentioned the fundamentals in terms of the president talking about infrastructure and then whatever else we see out there in terms of demand for copper. But then you also go back to the fact that we were basically trading in a 30-cent range for the better part of the year, all the way back to the beginning of November, and we were really low prior to November last year. Just looking at the price chart for the December contract, which is the highest open interest contract right now, and so you're going to get not only increase in the basic needs of the product itself, but then you get people who have no concern so much about that, but are looking at charts and looking for movement in charts. So you see going from 280 in the middle of or the end of August all the way up to 325. So there, in and of itself, on top of the fundamentals, that's going to help with your trade. In terms of people being interested again. And you get movement like that, people who don't necessarily want to be in the futures are going to want to be in the options. So that's always going to be, I think that's the one thing I've learned doing the show is, you think that you can't, you know a little bit about fundamentals, but you're looking at technicals, but then you look at the technicals and it helps you understand the fundamentals. I guess it's very circular in the relationship, but, as mentioned this week, Derek said 14,000 in open interest, but up almost 28% this week alone. And that is a bit, and we talk about this too in the weeklies, how we have numbers and from an absolute standpoint, they're not big, but from a percentage standpoint, they're very important because of the size of the change. So, the same thing's going on here. And I think again, this is easy enough for us to watch on a weekly basis, right? We can click over and see, and people who are listening and following along, you can click on these different links and you can see where the activity is, what strikes and what days it's taking place. So as far as making any additions to that, the big notice that I see here in the expirations that are greater than 30 or greater, we saw that, last week the calls were a little bit more bid, and this week they're almost offered. We almost have we have like a subdued smile. So the 25 delta calls and puts are both slightly rich to the at the money, but basically it's a pretty flat curve between the 25 delta put and the 25 delta call. So what's that tell you? It tells you we've kind of made a good run up from before. The calls were bid. Now we're at a point where people are, we're not quite sure which direction we're going to go. But there's a couple of ways to look at that, right? So you look at the vol curve and you see, people aren't necessarily sure. The pattern of the chart itself can be poised for either a break back down to some levels that we have been through and sort of, jumped right through without really trading around there, or we could be poised for a little bit push higher based on the fact that there was a rally, then a dip, and then we're back where we were. So people are getting out where they maybe got in on the highs and it's churning a little bit. And so that's why I think you see the vol curve be a little bit more sort of neutral right now.
All right, let's move on to the shinier stuff, the other part of the metals spectrum, of course, gold. We've talked many times about the gold bugs here on the show and how much they want upside. They did not get it this week. Gold giving up another 25 handles or so, right around 1280 out there in the big gold contracts. And that means interesting stuff out there in the vol space. We were saying recently that it was hitting, a 5-year low there, Nick, on the volatility cones. Is that what we had last week on the show there? Something along those lines.
Yeah,
right?
pretty much. We were right
in that range,
right near the bottoms there.
So the vol, unsurprisingly, kind of unched this week because at this point, getting how much lower can it go? Maybe we need to get Eric back on here. I know he likes to study all things implied vol and gold to see how this ranks on a historical spectrum for him and what he still to this date I think has one of the best timed research reports we've ever had on our network. He came out here a couple years ago and talked about the gold storm on the horizon for gold volatility, and I think 3 days later, gold vol exploded. So it was he has pride of place for that one on this network for quite some time. In terms of what was going on this week out here in the open interest, surprisingly quiet actually, given the sell-off, only up a little bit less than 1%. Where the action was centered pretty much out there in the front month, about 40% of the paper going up out there. 15 calls kind of leading the charge this week, about 8,000, nearly 9,000 going up on the tape this week. The lion's share, over half of that closing. So it seems like maybe not surprising after all that you see a big sell-off out here in gold. People may be giving up the ghost and some of the near-term calls deciding not going to happen, at least not right now. Coming up number 2 here, 1,300 calls. So a lot of call action this week despite the sell-off. About 5,300 of those coming. The lion's share, about 2,000 and change coming on Tuesday. Net actually unched on that strike, so not a lot of bias either way when it comes to those. And we go up to the 1270 puts. The puts weren't forgotten about this week as well, with about 4,000 and change. The lion's share going up on Wednesday. Decent amount coming up today, about 1,100. Also net unched out there. 1305 is a little call strip active out there. Also a little active, actually a little more than the puts, about 5,200 going up out there. The lion's share coming on Wednesday, 3,000 and change. About 2,000 that total on the week opening, I should say. So interesting stuff out there. And you listeners know we had some interesting paper out here in gold of late. So we always keep an eye on the longer term months to see exactly what is going on, and nothing quite as crazy here from a gold net long-term perspective. I think the longest term, most active thing we see out here is next year in the 12-half puts, about 2,500 of those coming up this week. That's net closing at least, so someone giving up the ghost looks like perhaps there. Other than that, Mr. Nick, we don't have the big crazy upside trade this week. Anything else catching your eye out here in the shiny stuff this week, sir?
Let's see. So we did have a crazy trade last week, right? We're talking the 2,000 strike, the 2,600, and the 3,000 strike.
The 2,600 vertical with the 3,000 call kicker 15,000 times. That's still, I think that's out there for my trade of the year so far. Crazy trade of the year, at least, yes.
Yeah, it is absolutely. That was the weirdest one we've seen. But again, I'm gonna sound like a broken record when it comes to talking about gold. I still feel, and again, mine is all disclaimed based on the fact that I'm just a technical guy. Technical meaning not a technical trader, but just a tech guy looking and who's traded, who's written the software that looks at the stuff and I pay attention. But I still see, there's good opportunity in these options. We always talk about this, Mark, where we get down to the bottom of what has been sort of the common range in gold. This to me seems like in the level of volatility that we're currently trading. It's a great put purchase time, a hedge put purchase time. And again, it's not a trading recommendation. Just from a very practical standpoint, we're at the bottom part of a range. Volatility is very low. The skew is cheap to the put side, and we've rallied. We're off 25 bucks this week, and we were just up trading up 13.20 earlier in the week, or even last week. So it is a great place to do this low volatility hedged purchasing, in my opinion, right? So for me, that's always interesting. I love the gold because it has such a great range. The vols, given how low the vol is, it still has a great range. It still gets hammered because it's staying in that range, but I think it's a great trading range, and it's a great hedge trading range, especially if you come from a background of being a vol trader and appreciate those kind of things. So looking at that, that's kind of my comment there. As always, the skew, we don't see too much of a change here. Calls are still rich, puts are still offered, but not tremendously offered. So that's getting a little flatter to the at the money. So that tells me that we might, there might be some change in sentiment, but I'm still a put buyer, a hedge put buyer down here. The other thing I noticed, and I just was, because of last week and looking at the goofy call spread versus the double kicker on the 3,000 strike, I was looking at I always try to go look at the block trades now the last few weeks so we can see if there's any interesting. We see the strikes in this week in options report that kind of stand out, but you go look at the block trade because sometimes the strikes, they're independently represented in the report because it doesn't tell you whether it's part of a trade. But if you go to the block trade browser, that is actually being released as part of the CME Direct integration, quick strike integration this weekend. So you'll be able to utilize that, and it's a block trade browser that lets you look at the trades as spreads themselves, so you can see them very easily, and you'll be able to filter by product. And it's not just going to be limited to products that are within quick strike. It's going to take advantage of the global product browser that we've recently built as well for CME Group, and you'll really be able to take a look and get a good idea of what's trading very easily and really narrow things down and take to do your research even more thoroughly. But the one thing I did notice out there were some call flies by 1,400, 1,600, 1,800 call flies, 1,500, 1,700, 1,900 call flies. So we still have people out there. You buy call flies because you expect things to move toward, toward that direction. Now there's a seller obviously on the other side, but they were entered as buys. So that my assumption is always if they're entered as buys, that means that's what the block participant who initiated the trade did. I might be wrong, but that's a question I actually have out to a few of my friends over at the CME to give me some insight as to whether that is actually the case. But, that means there's some expectation that we move higher, but maybe not necessarily that much higher. So those are call flies that will probably trade relatively cheaply given how out of the money they are. But, there's a bias towards some upside. So that was sort of a little bit more of the interesting stuff that I happened to notice just by skimming around in the block trade browser. But, kind of still up. Small amount in open interest, always good, given that we're kind of in this regular range that we've been trading. But I still like I say, and I repeat it every week, I like puts down here. I like long, cheap volatility hedge puts. So same as always, broken record.
Good stuff on the block trade browser. That's something you like to get into the show more because that shows a lot of insight into what's going on in some of these large. People kept asking us, what was going on with that crazy trade in gold? And that shows us we need to get the block trades in there on the show a little more. Any other thoughts on what he just brought up there, Derek, or any other thing catching your eye out there in the metals and in the shiny stuff this week before we move on to some other products? Yeah,
just at the macro level. I mean, you look into context of what this metals market has done over the last 18 months. We're wrapping up Q3 reporting, getting ready for our earnings call next week. So I was in the data this morning, and we have set for the 5th consecutive quarter, we set volume records across our metals complex. So we're seeing that. We're also seeing the backdrop of the point Nick made of we're coming off from that mid-1300s range back down. We're seeing volatility creep back down as we lower back into a more kind of normalized trading range, but that has not diminished the volatility in the volumes percentage. I look at September. September volumes were up, I triple-checked this number, 72%. So our September monthly ADV versus 17 versus 16, up 72%. So this is a market where there is terminal demand, where we're expanding footprint into the industrial metal side to add to that which we already have in the precious side. And at the point Nick has made, there's no shortage of folks out there thinking, hey, I want the best, most capital protected way to be able to play for an extreme upside move. Why else would you be playing for those kinds of call spreads with those legs? So it's a great market. It shows end user participation, growth in open interest participation, and volume. So while we're seeing a kind of a structural pullback or a cyclical pullback in volatility, we're certainly not seeing people pull back from putting risk positions on. So we'll continue to push more access and more products, and the work that Nick is doing to both make this market more transparent and more easily understandable is the perfect combination for adding participants and getting folks more comfortable that this is the best place for them to express a metals position and participation.
Obviously we're talking metals, we're talking energy here, but there's a lot of other products out there. And I know your domain, your purview, Derek, is kind of all things options over these days over there at CME. So before we get into some of the other big movers and shakers of the week, anything else, kind of coming across your tape you want to share with our listeners in terms of interesting developments, trends, volume, things like that you're seeing over there, kind of across the broad swath of CME options?
Yeah, I'll do my best work at being kind of the enterprise level kind of view here, because with Nick and yourselves on the line, you guys are fabulous about pulling out the macro details and certainly using Quick Strike to point to the very kind of nuanced picture of what's going on underneath. But you take a step back, you look at the market this year. CME Group as a whole is up 6%, which is actually pretty solid for a year that we're seeing, record low volatilities and some challenges in certain asset classes. Here's what's interesting. We again are posting options volumes that are significantly outpacing the underlying growth of the franchise and significantly outperforming sort of other markets. So while the overall business at CME Group year to date through September is up 6%, our options franchise is up 14%. Significant growth, and it's almost counterintuitive when you look at to the points that Nick was making earlier. In every asset class, we're seeing cyclically low or sometimes all-time lows in volatility. But how do you overcome that? Well, we're trying to be working and responsive to our customer needs and putting product out there, working with Nick to get analytics out there to get greater transparency as to what's going on in the market. But the growth of our options complex has been a great driver for participation and bringing new folks in, whether they were ETF options traders or maybe they were securities traders, looking for markets that are continuing to grow and expand and globalize in a market that maybe you'd think would be challenged a little bit. We're bringing net new people into our market. So this is a terrific opportunity for people to understand what's driving growth at CME Group that you're not necessarily seeing on other exchanges or in other venues. So at the macro level, very pleased with the results, the transparency we're creating, and the global participation we are adding, it's a great global growth story. And I like to think about the concept of a coiled spring. In markets that are challenged structurally or cyclically, or maybe you're seeing no real external kind of motivations for dislocations in markets, we're investing such that when you start to see dislocations, when you see a normalized rates environment or a volatility environment, we're starting with record levels of participation across our options franchise, across asset classes. So we've gone deep and nerded out a little bit on some of the individual products, but the detailed story tracks the global story at CME Group, which is growth across every single asset class, even equities. Equities as a franchise is the only of our 6 asset classes that's not net up on the year, but equity options are up on the year. Why? Low vol environment. Folks are playing for smaller moves, shorter points on the curve, weekly Wednesdays, weekly Fridays, weekly Mondays, bringing more folks in. So it's a good macro story. It tracks largely with the micro story by product, but it's one that is a differentiator, and we're glad that folks can learn more about the side of the business through programs like Options Insider and using Quick Strike.
I don't know if you know this, Derek, but we're all about nerding out here on the details of the strikes and the activity. That's kind of what we do, which is fun. But you're right. Looking at it from a macro perspective, if you just were given this data set and stripped away everything else, and they just said, "Hey, vol will be here, and here's what the market's doing," and everything else, you just looked at that categorically, 10,000 foot level, you'd say, "Oh, wow, the options market's got to be just cratering. This is a terrible environment for that." And yet we're not seeing that. We're seeing these surprising pockets of uplift, which I think is surprising a lot of people. I don't know, Nick, are you as surprised as well, or maybe this is kind of what you expected, despite all the macro trends to the contrary?
Well, first off, Derek's always going to be able to talk more thoroughly and intelligently about the specifics of CME, but I try to do my best to point those out when we're by ourselves and we don't have anybody in the CME hot seat. The one thing, and to reiterate what Derek said, he mentioned the Wednesday weeklies and the equities as helping the cause in terms of keeping that volume up. And I talk again I'm talking to the guys at the CME all the time, and you're seeing that same sort of the daily options are even trading in the nat gas. That's quite a bit of an increase. And again, the numbers from an absolute standpoint aren't tremendous in terms of their size, but from a percentage standpoint, it's really making a difference. And that's been a big push as well, is to get those dailies out there. And to Derek's point, as far as the weekly goes, we have tighter ranges, but what the weekly options let you do, it's basically like trading a future that's cut off in one direction or another, right? So it's a low premium play on a particular direction in a short period of time. So you see all of the available weeklies in the equities. You see the stuff like, as I mentioned, that just said that the nat gas is trading better. They're trying to do the same in terms of the crude. You're getting Wednesday options releasing next week from Monday, I think, in the FX. You'll get Wednesdays in the FX. So all these things, you get tighter ranges, and maybe people aren't necessarily trading. Maybe the futures are steady in terms of the volume. Again, I don't know that number, but from being able to play these sort of binary directions with the short-dated options that don't have a lot of time value but have low volatility value in them, you're really starting to get a much greater opportunity to just do different things that you wouldn't necessarily be able to do with a regular quarterly or a regular serial.
Speaking of things that were active and remained active this week, you guys always like to ask us what's moving, what's shaking this week. So we'll break it down for you. This time, a purely underlying based, no implied vol, no open interest, to see what was moving for the weekend. Once again, lean hogs tearing it up to the upside, up about 4.25%. They keep sneaking in to the narrative. You guys keep asking us, what about lean hogs? Maybe we'll have to get them onto the show again next week. Talk more about all that fun hog stuff. Our Bob also up there, number 2, and about 2.75%. The E-mini Dow up about 1.8%. Up there as well. On the downside, the dark side, soybean meal taking it on the chin about 3.6%, 3.25% to the downside. For KC wheat itself off about 3% there. So maybe time to get a little more ags on the rotation as well. Speaking of rotating things in, it's time to rotate you guys on. It's time for your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, everybody. It's time for your questions. Like the man said, the futures options feedback. You know how to reach out to us. Social media. Questions at theoptionsinsider.com. The website feedback form. All that fun stuff. Even the live chat. No shortage of ways for you guys to reach out to us. I thought I'd start off. I'd like to ask you guys a lot of questions. We asked one actually on another show this week. It was just a little quick flash poll we did. It wasn't up there for very long. But the response was so strong and so overwhelming. And it seemed to draw so much into what we talk about here on the show that I thought it'd be worth discussing on this show as well. We asked you guys a couple of days ago. We said, do you think options should be traded after hours, just like a lot of stocks are? And overwhelmingly, 71% said yes. And maybe, Derek, maybe this is one of the reasons why we're seeing these pockets of interest on the futures options side of the fence, despite a lot of the macro trends to the contrary, because people clearly want a broader time set. They like the extended hours. Maybe they work. They can't get in the time to trade the products they want. Or maybe they see something. They have time to get home to do some analysis. We hear this. I mean, usually it's this time of year anyway where we hear this question a lot on the equity side because of earnings, of course. People want to be able to play earnings throughout where the actual move is as opposed to waiting until the next morning. So we get this question a lot now anyway. But it seems like this is really spilling over into maybe a lot of demand for the futures option side of the fence because a lot of the products out there do offer a slew. Are you hearing that from a lot of the clients out there that maybe that's some of the reason they're starting to gravitate in towards that, or that is because they like I guess you can call it the extended availability of some of these products out there?
Absolutely. I mean, there's no question it's been a push me, pull you in the market. So, for example, we're certainly picking up European and Asian participants because we can provide actionable liquidity on our screens, delivered through Globex, through CME Direct, with the analytics from QuickStrike fully available from the Auckland Open all the way through to the LA close. It is a global trading day in our products. I think that's also consistent with demand for benchmark products. If there's going to be a play for a global equities exposure, people are going to gravitate to our S&P mini contract. Why? Because you can trade it 24 hours a day. Carl Icahn was quoted on the day of the Trump victory in the middle of the night. I think it was 1 a.m. Chicago time. He waded into the market, and he was quoted as saying, I bought $1 billion with a B, $1 billion of S&P futures on the CME Group platform because that's the place that I could trade it. And that is, in the most macro possible way, the exact reason why we are globalizing distribution of our product, reaching out to participants in Europe and Asia, because if you want global exposure to the global benchmark, you need to access it in your time zone, and you need to access it through a front end that's native to your operation. In the same way that we saw business naturally flow outside of just normal pit hours, when we put side-by-side trading in place beginning in 2001, it was a recognition that customers want to be able to access our markets during their native trading day. It's just an extension of that thought process. And when you have S&P minis as the global benchmark for equities, and you've got WTI as the global benchmark for crude, our COMEX gold as the global benchmark for precious metals, so on and so forth, these are markets that the Asian participants want to trade the benchmark product, not a local spot market, not a local ETF, the global liquidity pool. And they can get in and get out at any time of day or night based on what's going on, OPEC announcement, Florida releasing their polls from the event or otherwise. So there's no question that globalizing participation actually is a virtuous cycle. You start to bring participants from outside the U.S., and U.S. participants are saying, hey, I can actually interact with liquidity in the Tokyo morning when there's great Japanese demand during their domestic hours. So it becomes a self-fulfilling prophecy of globalization. Liquidity breeds liquidity. It's the same old adage, globalizing liquidity breeds globalized liquidity. So there's no question that's a focal point of ours and a big part of our success to date, and that we'll continue to work on.
Yeah, it's funny because we asked that question a lot, and this one was kind of just a little quick one we just did. We didn't put it up for very long, but usually the response is closer to a 50-50. We have a lot of pros out in the audience, too, who say, I don't want to be up there manning my markets at night and stuff there. So it's a little interesting back and forth, but this one was overwhelming in one direction, which kind of surprised me. I don't know, Nick, did it surprise you as well? And do you think maybe, like Derek says here, that maybe that's part of the reason we're seeing these spikes, these resurgences of interest in some of the products here on TWIFO?
Yeah, I wouldn't say it surprised me. I just sort of already kind of thought of it as trading 24 hours a day anyway, outside of the little closing period on the Globex to recycle the system. So no, it doesn't surprise me. And if you go out there, and in particular, if you go out there on CME Direct, which is which is a very comprehensive trading platform that has Quick Strike integrated in there as well. And you go look at the bid-ask spreads in the after hours market, you're going to see they're pretty tight. The size may not be what it is during the day, which is obvious, right? Because you have a majority of those market makers that are trading the U.S. hours, but the spreads are great. So when you talk about having markets in multiple strikes across multiple expirations in all of the benchmark products, and you get a good price, you're going to have the ability to trade pretty much whatever time frame you're looking to trade. So yeah, it was surprising from a question is it's because I thought the answer was already yes. Maybe that was more of an equity option based question than anything else, because I don't really know much about the individual stock equity option market. But yeah, I mean, it's for me, I'm looking at it for a couple reasons, because we're trying to, fit volatility curves throughout the day, and those markets are extremely tight. So we're always trying to pay attention to see when we could start doing those for CME throughout the rest of the trading day. And it's getting closer and closer where those markets are solid enough and consistent enough, meaning they don't disappear at night. They're open and they're there. So yeah, I think it's only gonna get better. Only gonna get better as more of the world is trading those products, and you'll get tighter and tighter markets, which I'm surprised you can even get much tighter markets, but more size on those other sides of the markets.
Yeah, I think the only thing that surprised me was the 25% of folks that said no. We'd love to hear from you, 25%ers. So give us a call, and we'll talk to you about the benefits and merits of being able to enter and exit into positions at any time of day based on any event risk.
From our experience, those tend to be exchange operators on the equity option side of the fence who seem to be just universally against, whenever I ask them this question, the heads of their exchanges, universally against such a crazy idea as keeping the products open a little bit longer there. All right, we're kind of coming up against it here. We got so many questions. Let's see if I need kind of a quick one to Russ. How about this one? This is a nice quick one we can do. This could be for everybody really here. This comes from this impenetrable handle. T6BTL wants to know, hey, they're big on the Fed Watch. There you go, Nick. You got a fan on the Fed Watch. Any other cool tech coming to the site? Well, I'm assuming he means the CME Group site, not Options Insider or something like that. Derek, he's a big fan of Fed Watch, which is cool. What else you guys have up your sleeves that might be kind of fun for this T6 fellow as well as the rest of our audience out there?
Well, I think Nick is continuing to find new ways to create transparency and understanding through the analytics that he's been putting up on our market. So I'd love to have Nick share a little bit of the stuff that he's been doing and the recent work that he's been doing to put more functionality and analytics up on the site that is in support of our products.
Well, Nick, the Fed Watch is kind of your baby. What else? First off, you're getting some love here from T6, so there you go. And then secondly, what else you have up your sleeve there? Don't spoil too much. We got to give our hints, our plugs at the end. What else you got coming for tool-wise on the CME site?
Okay, first of all, FedWatch is a tool we built for the CME, so it's the CME's baby. We just kind of gave it a little bit of a facelift. So I don't want to take too much credit for that, other than the fact that we built it to the specifications as the exchange asked us for. So first and foremost, I want to make that pretty clear. I mentioned earlier that there's going to be, and I mentioned the product browser and the block browser. I talked about that being available within the CME Direct integration. That will also, the timing is a little bit lagged just because of the way we try to do it. There's one way for us to vet the product through the integration, and then we'll release it to the public site coming up here. But that block browser will be there, and also a product that, there's ways to see the product list on the CME site, but there's one thing that's been in the works for a while is this global product browser, with not only let you go and do easier searches to see the products that are trading, so you can see everything tied to crude, for instance. So you can type in CL and you'll be able to get every option that's tied to crude. But what's going to be a nice part of that feature is you're going to have the ability to export all those expirations. So if you're looking to see what the different expirations are on a particular contract, so now you can go to one place, get a complete list, look and see what the expiration dates are, and really find something to tailor it specifically to your trading. So the block browser and the product browser, those are built on the same technology. So those are going to be great. There's going to be historical views into that block browser. And also from that product browser, you'll be able to get underlying charts right away. Very, just pop them open right at the same time. So there's going to be a lot of neat things that are going to be immediately available to the user once they visit the site, and more ways for them to get in-depth information about a particular futures or options contract as well. And on And on that same product browser, there'll be links to the contract specs. Now, all that stuff is there, but we're just trying to make it more consolidated and a little bit easier to navigate. And then the one big thing, and we'll pitch it now versus at the end of the show, because we'll just kind of wrap up how we usually do. But one thing, everybody who's listened has heard me talk about the free version of Quick Strike called Quick Strike Essentials that's available on the CME Group website, cmegroup.com/quickstrike, QUIKSTRIKE. But last week we integrated a piece to Quick Strike Essentials called Quick Vol, which will give you 1 month of a window into the historical data that's available from the CME Group and from Quick Strike, but a 1 month window into that so you can do charting and see all the different things we talk about at the money implied versus the actual futures, the quick skew, the skew, the individual skews of the calls and the puts, the volatility curves and vol curve comparisons. All those kind of things are available for current expirations, historical expirations, as well as constant maturity expirations, and the ability to at some point be able to get access to purchasing downloaded versions of that data as well. So log into Quick Strike Essentials. You can either create your own login or use the integrated login that's available if you have a CME account already, and take a look at that, because I think I'm pretty excited. I'm most excited about that, finally getting that out to the general public, all the different volatility tools that are available.
All right, glad I picked a short one there, Nick, because that's a lot of detail to get in there at the end. But good stuff, good questions, everybody. Sorry we didn't have time for more. That's what happens when there's a lot actually happening in the world of futures options. Because it makes it hard to get, maybe I'll have to have an all-question show one of these days. But before we wrap up, Derek, I know you guys are always working on a lot of cool, interesting stuff over there. Perhaps even some new product launches coming our way in the world of options. So we want to leave our listeners a little hint, a little tease of what's coming down the pike from CME from an options perspective. Now is the time, sir. The floor is yours.
Well, we never are able to tell you exactly what we got in the hopper, but you will see continued growth from us and investment in our front end, our functionality, our global participation, working on some interesting additional pieces in the front end of the curve across a few different asset classes. So stay tuned to the show, because this is your best chance of hearing it here first as to what we're doing and how we can help you manage your risk.
There you go. You heard it here first. And on behalf of Derek and indeed Mr. Nick, and of course myself, I want to thank all of you out there in the listening audience for downloading, streaming, subscribing, of course, tuning in live. We love you guys too. And we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. Quick Strike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quick Strike has you covered, with market data reports ranging from open interest to the term structure of volatility. Quick Strike is the perfect addition to your trading toolkit. Learn more about Quick Strike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.
The
preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.